Hello traders, this is the first video in a series. Basically the series will cover topics from beginning to advanced. Hopefully coming into this you have a basic understanding of what Forex is and why you might want to trade it. And you've kind of made the decision to trade it but you don't know where to start. It's kind of where this series is going to launch from. So I hope you enjoy it and I hope it helps you out. Today first I want to talk about the three types of analysis, just because I think it's important to realize there's more than one way to analyze the market and become a profitable trader. You know, some traders are pure technicals, some traders are pure fundamentalists. Some people just think that risk sentiment explains it all. It just depends kind of who you are and what you're good at and your psychology and your opinions, right? From my personal standpoint, I pretty much 80% technicals and kind of a 20% fundamental guy. It just seems to be what works for me. I have some tools to analyze risk sentiment for long-term positions, but it's not that big of a part of my trading kit, but we'll go into that in later detail. So to start, we'll just talk about what the three types of analysis are. There's fundamental, technical, and risk sentiment. To start with, fundamental analysis is basically the analysis of a country's economy. So let's say you were trading the US dollar versus Canada. If you're a fundamental trader, the important indicators or the important thing to realize is the health of the economy for the US and Canada. Basically, different events, news, and politics that affect the economy have impacts on the currency market. For instance, if the Fed cuts interest rates in the US, this is seen as negative for the US, so the dollar will suffer. It's not quite that simple, but it's a basic example. Or say that in Canada retail sales were down, but in the US they're up in the same month. Fundamentally, the US looks more healthy than Canada based on that one element, which would be retail sales. Again, that's a very simplified version, but that's the gist of it. Basically, you're trying to come up with like the health of an economy. So you kind of act like the doctor, and you have different things you're measuring. Like taking the temperature, and when the doctor listens to your lungs, you kind of do the same thing for economy. You look at interest rates and different economic reports, news, and politics. Later on in the series, we'll go into more detail about fundamentals and kind of what economic reports to look for and maybe how to trade those. I have certain trade setups where I trade economic reports. I might go and show you some of those and maybe integrate it into your whole system later on. But for now, I think that's about all I wanted to say about fundamental analysis. To move on, technical analysis is the study of price action. What does that mean? Basically, the exchange rate of a US dollar versus the euro or Australian dollar versus Canada. How does that price move up and down and sideways? I guess the fundamental theory started is that if you were able to analyze the past, you could predict the future. And so technical analysis was born. Some of the ways that technical analysis is done is probably the most favorite is charting. Whether it's a bar chart or a candlestick chart or a line chart. There's also swing charts, point and figure charts. There's a whole plethora of different ways to chart price data. But it's just an effective way to represent price action in a visual way. Now, that being said, not only are there tons of different charting methods, there's also, for each charting method, each person has their own interpretation of that chart. So technical analysis is pretty subjective. Even indicators like you see right here, I have a stochastic, I have it set to 14, 3, and 3. Someone else might use stochastics and have completely different parameters and come up with a different outcome for the market. It's kind of important to understand that even technical is subjective. And but that's a positive thing, because you can come up with your own method that works for you, you know. And I think that's the most important thing to realize, is that you need to come up with a technical tool that is simple and easy to use and makes sense to you. And that'll help you to become profitable in itself. Let's see, what else? Technicals. Yeah, other than that, I think in the future we'll cover in more depth kind of some of the more popular technical analysis methods. You know, like especially the ones that are easy to use on MetaTrader. For instance, I forgot to mention, this is a MetaTrader platform. For anyone that's not familiar with it, I think there's a video on the website that explains it and how to set it up and what it is. It's one of the most popular trading platforms, and it's also one of the most customizable. You can write your own programs. You can you know, draw your own chart patterns. You can make your own indicators. It's really an awesome thing. But anyway, to move on to the third topic, which is risk sentiment. This one's kind of tricky to explain. Now, I guess the best way is to give an example, but to start with, basically risk sentiment is the market a bullish market? Is it going up? Or is it like a bearish market? Is it going down? Now right there, that was just a difference in time frame, but this difference comes back to my point, is that risk sentiment is really kind of the analysis of the general psychology of the market. You know, is the market bullish, or is it bearish, or is it somewhere in between? And it comes down to people. People are the ones executing trades. All the stuff you see on this chart, even if it's just ticks that you're looking at, is as a result of someone executing a trade. You know, they might be motivated by fundamentals like news events or politics, or maybe their buddy told them that, you know, buy Australian right now because gold's going to rebound. You know, there's millions and millions of reasons why people do what they do. And I guess the analysis of a risk sentiment is basically trying to get behind that and see where's the majority, where's the mass psychology lie. You know, are they bullish on this, or are they bearish on that? You know, where does that lie? I think it's important because you kind of want to be on the right side of a train. You know, you don't want to go head on into a steaming train. You'd rather catch a ride with it. And so that's kind of the gist of risk sentiment. We'll go into that in more detail later in the course. I think what we'll do is the next 3 videos / posts are going to be, you know, more detail about fundamental analysis, technical analysis, and risk sentiment. I just kind of wanted to give a basic overview first before we dive too deep, and kind of give a more cemented concept that there's 3 different kind of methods to analyze a market, and then we'll go in more detail. And I think that's all I want to say for today. I hope you enjoyed the video. Have a good day.